The Fed fails to halt gold. Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, who's been completing a deep dive into the minutes of the Fed's latest FOMC meeting and what they've been saying in an attempt to figure out what it means for the markets and interpret any hints of what we can expect pretty much next and going forward. So, how are you going today, Sam?
Very well, Chris. How are you?
Yeah, I'm good. So you looked at the FOMC minutes from September that have been published, and there was a lot of conversation going on around, uncertainty or clarity that they are providing. It's really can be a bit confusing. So can you start off by going through some of the highlights of that for us to really give us the big picture of what they're thinking?
Sure. So they said that economic activity expanded, but tight credit conditions could have a negative effect on that, as well as on hiring, because unemployment's a major thing that they're tracking. And they also noted again that the U.S. banking system is strong and resilient, and that was their second main point. So seems like they're really trying to hammer on that there's nothing wrong with the banks.
Well, see, what confuses me about that is, first of all, that's a bold statement that they're making, but it sounds exactly like what they've said previously. Except maybe they're doing a bit more to acknowledge the tightening credit. But it's the same message that we're getting from before. But I get the feeling, at least, that things are starting to change. So, were there any hints of a plan on future hikes? What are they what else are they giving us that we can hang our hats on here?
Well, some of the participants, not all of them, but some of them were talking about, instead of one more hike, if they pivot to just holding the rates as they are and letting that do the work. And they suggested they should move away from talking about one more rate hike. In the end, it doesn't really matter that much because both will do a lot of damage. I mean, it still looks like in the 80s when rates were held really high for a long time. And okay, there was one more hike just to tip it over the edge, but that may have happened anyway if they just held on a little bit further.
Yeah, right. So, was there any positive in there as well? Like, if you think about the economy, aside from them saying the banking system's resilient, and that again is interesting to me because, like, it might be looking resilient at the moment, but it certainly is under a lot of pressure from those bond yields. So, what else were they saying in terms of the economy itself?
So one kind of interesting comment was that they decided to comment on the consumer spending, and they said it was better than expected. Now that's flies in the face of what we talked about a week ago, because we were talking about a report done by Citi that was talking about credit card spending, and September was the worst month of the year. Not only that, it was the fifth month in a row that spending dropped. So going by analysis from other bodies, it looks like September was a horrible month for spending. So it's interesting why the Fed decided to come out and have their positive be that consumer spending is strong or better than expected. What are they comparing it to? Where did they get their expectations? That's what I'm wondering.
And that's what's confusing me about this, right? Because I think you hit the nail on the head there, actually, with this idea of consumer spending, because that's the one that we feel, right? That's that I keep not being able to express in words properly what it is, but there's a feeling going on that everything isn't quite right. And I think that credit card spending was a perfect example. It showed that it was really weakening, that people are really feeling the impact of this, but you wouldn't know it based on what the Fed's been saying there. Is this just an attempt for them to justify interest rate policies? Is that why they're being
I think it
upbeat?
is.
Yeah.
So I think it is. It's because think about if they went out and talked about how bad the credit situation was more blatantly and mentioned, studies like what Citi has published and what others have been publishing about the credit situation. I mean, they noted that, but they noted that on the back of a positive. If they wanted to talk about, consumer spending in September, and they talked about some of these things we were discussing last week, it would look like they're purposely trying to crash the economy. People would be saying, how, in September, are you still holding rates high? How are you calling for more, one more rate hike in the face of this horrible news? So you need some good news to justify whichever they do, holding higher for longer or hiking.
So don't, like, that is comical to me, because I think you're right. I think they're doing that because they don't want to be accused of crashing the markets on purpose. But at the same time, isn't that the entire point of why they've been raising the rates so aggressively as they were? And they still keep saying, well, maybe not so much currently, but the measure seemed to be unemployment. They needed unemployment to kick up. By definition, unemployment rising is them crashing the markets. It seems comical, doesn't it?
Yeah, it doesn't really make sense. And the thing as well is people don't understand that you just can't have growth all the time. You can't just, you can't just put infinite fertilizer on crops and keep growing more and more exponentially. You can't just print money into the stock market and have it go up forever. It doesn't work like that. There actually have to be ups, there have to be downs. And it seems like people are never prepared for the down, whether it's the average consumer who has their pension money in there and they'll panic if they see it start to dip, or whether it's someone on Wall Street who sells more shares if markets are going up. So everyone wants up all the time, and that just doesn't happen. So they probably do have to do this and crash the market and reset prices to where they should be.
I love your use of the word fertilizer there, because one could argue the Fed is pouring lots of fertilizer on the market. Certainly, they speak a lot of it. Changing topic slightly. So through all this, I mean, obviously our audience is very interested in gold. We're very interested in gold ourselves. So gold is really interesting here because it seems to have powered through that news and continued to rise. We've seen it really hold up remarkably well, and sentiment really not take off that much either. It's been just holding really nicely within striking distance of those highs. Do you think this can keep going from here?
Well, firstly, I'll say it was surprising seeing that the week of the FOMC, and then we have CPI data coming out as well. A lot of times you'll see gold just take its foot off the pedal and sit still because investors are scared to make a decision when there's a bunch of data about to come out, which could put their investment either quickly in a profit or a horrible loss, either one. Or there can just be major volatility both ways. But it seems like it almost just shrugged off the FOMC. It kept powering upwards. The last daily candle was about a 1% rise up. So pretty aggressive march upward. Now the stock market's been doing kind of the same thing. So you want to make sure it's not, too tied to the stock market. It's not too tied to just what the dollar's doing. But what we also have is the situation with Israel and Hamas going on. And you can clearly see that I know this issue's been going on for decades. That's what some people are saying. Look, it's old news. What else? What else is new? They're fighting, but there's a clear escalation, and a lot more deaths have been happening. And it's a military. It's a getting to be a larger scale military conflict. And I think personally, my worry, and something I think could dramatically send the price of gold higher and help disconnect it from what the Fed's doing, is we're seeing talk of, asking if Iran's involved.
Yep.
Saying there's no hard evidence Iran's involved in, funding Hamas. There's no hard evidence they helped plan the attack. Okay, there's no evidence maybe, but why are they asking the question? So if they're asking that question, it might mean they're poking around, they're looking for that involvement. And if Iran gets dragged into this, if more countries get dragged into this, then what do we have going on? Well, we have tension around Taiwan, Pelosi flying over there, China doing flights in the region. We have a hot war going on in Ukraine, and then also we have the Middle East, and Iran's a huge country. So if the whole world just gets tied up in these major, not minor, but major proxy wars, who knows when it can stop.
And we had a really interesting discussion yesterday. I was speaking to Branko about this, and a couple of things we mentioned were first of all, you don't need to be a geopolitical expert. A lot of people seem to come out at this time and think they're geopolitical experts. You don't need to be one to realize that there's potential for uncertainty in the markets, and that the impact can be quite significant because of the uncertainty in how these things unfold, right? Like it's never clear. You've got people directly fighting each other. It can escalate very quickly and involve other people. So you can't really pick what's going to happen. But what we noted that was we found really interesting was how stable the markets have generally been. And the best we could put it down to was a sense of maybe complacency, but we were calling it war fatigue, where because we've had the situation in Ukraine going on for so long, and people sort of like, yeah, pretty much what you just said before. They've been fighting for a long time. They're just fighting again. Okay, whatever. But there is potentially a risk there that is being underpriced in the markets, that people really aren't considering how this could escalate, and that these are bigger players, I suppose, than some of the other conflicts that we've seen brewing. Do you sort of think the same, or do you have an opinion on any of that?
Yeah, well, there has been so much emphasis put on Ukraine. It was supposed to be the reason for all the inflation. It was supposed to be the reason for everything. Now we have another war going on. As far as war fatigue goes, okay, maybe people are tired of reading about conflicts and putting new flags in front of their Twitter handles and things like that. Who knows? But it is I think what we might see is, if there is some connection made to Iran, or it keeps, there's a continuous attempt to drag in other countries into this. I don't think it's going to be something people can be too fatigued to read about. I think it's going to start dominating the investment landscape, and we'll see a big change in gold.
Yeah, that's right. When that happens, we'll start to see some real moves potentially in the market in both ways. The volatility will come if people go, oh, hang on a second, I do need to start paying attention to this. So yeah, it's one to certainly keep an eye on. I think that's pretty much all we had to discuss on that today. So I think to wrap that up, really, you'd sort of say the FOMC is looking like they're just trying to spin the positive. We're worried in the background about a lot of potential for volatility coming. Is that the summary you'd give?
Yeah. So in summary, it looks like they're digging as deep as they can to try to find good enough news that they can justify keeping those rates high. Meanwhile, there are literal wars going on in the background, and both of these things are eventually, in my opinion, going to reach the markets. And the S&P 500, or the S&P 7, as some people call it, might correct.
And that's something you've certainly been saying consistently. So we'll continue to keep an eye on that. All right. Well, thank you so much for that today, Sam. Really appreciate your insight into all of that, and digging in to really the nuts and bolts of what they're saying at the Fed. So thank you for that.
Thanks, Chris.
Thanks everyone for watching. Remember, reach out with any questions or comments on the social platforms. We really appreciate those. That's us for this week. We'll be back next Tuesday, probably with Alex at this stage, to discuss all things markets and metals. Until then, have a great rest of the week and weekend, everyone.